bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the August 13th, 2024 podcast. As our audience on YouTube can see, I'm here with several of my partners, John DeJovine, Brad Elphick, and Jason Watkins. I've invited John, Brad, and Jason to join me to discuss the historic rehabilitation tax credit, the new markets tax credit, and the opportunity zones incentive, as well as collectively we'll discuss private activity bonds. All four incentives are important tools in community development and affordable housing. All four incentives were also part of the testimony that I, along with three other witnesses, gave last month during an appearance before the Senate Finance Committee about the role of tax incentives in local economic development. In today's podcast, we're going to take a broad look at several of the incentives that were discussed during the hearing. We're going to talk about what the legislative horizon looks like for each of these incentives, as well as talking about how they can be combined to have a greater and deeper impact on local communities, from urban areas to rural areas. Two, as a few senators asked during the hearing, Native American lands. Of particular importance for the new markets tax credit and the opportunity zones incentive are their looming expiration dates. Many of the incentives introduced, expanded, and extended in the 2017 Tax Cut and Jobs Act. Among those introduced was opportunity zones with the looming December 31, 2026 date by which investors need to recognize deferred gains. We'll discuss some of the possibilities in Capitol Hill, the opportunity zones, and other incentives. Additionally, throughout our discussion, we're going to talk about another element of the hearing, and that's private activity bonds and the low-income housing tax credit. Now, we split today's discussion into four parts. First, we'll look at the legislative future for these incentives by focusing on bills that have been introduced in Congress. Second, we'll talk about some of the complexities of combining credits in the opportunity zones incentive. We'll also discuss some specific challenges facing each credit. And then lastly, I want to get my guest thoughts on each incentive. We have a lot to discuss, so if you're ready, let's get started. John, Brad, and Jason, welcome back to Tax Credit Tuesday.
Thanks, Mike. Great to be here.
It's a pleasure to have all of you back, particularly all three of you back in one podcast. Brad's last appearance was in June as our first guest host. And then John was on earlier this year to discuss gap funding for historic preservation developments. And this is Jason's first appearance since last summer. He was on to talk about hot topics in opportunity zones. Now, before we dive into this week's conversation, I do want to go around the horn. Each of you introduce yourselves and please share with our audience some of your areas of expertise in the services you provide, particularly focusing on the tax incentive you're here to discuss. And I'll start with John in the sort of lower left corner, and then we'll go to Brad in the upper right, and then Jason. Take it away, John.
Thanks, Mike. As you noted, I'm John. My name is John DeJovine. I'm a partner in Novogradac's Cleveland office and specialize in historic tax credits. I work in financial forecasting and transaction structuring for complex HTC transactions that often include the other incentives we're talking about today, LIHTC, new market, and opportunity zones. Also work doing audit, tax, and cost certifications, and with several LIHTC syndicators. And I'll turn it over to you, Brad.
Great. Thanks, John. Brad Elphick. I'm a partner in the Atlanta office. And if you change HTC for NMTC and everything that John just said, I pretty much do very similar things related to new market tax credits. In addition to transaction services, audits, tax returns, and a whole host of other services, I also host our new market tax credit working group, which is an industry-based group that tackles different programmatic issues related to the new market tax credit.
Thanks. My name is Jason Watkins. I'm a partner in Novogradac's Atlanta office along with Brad. I've worked quite extensively in the past with both new market tax credits and historic tax credits. And for the last 6 years or so, I've been one of the leaders in Novogradac's Opportunity Zones practice. I co-lead the Novogradac Opportunity Zones Working Group. It's a collection of industry professionals that meets regularly to propose legislative regulatory improvements that will enhance the OZ incentive and also to develop best practices for practitioners to be able to establish and maintain compliance with the OZ rules and regulations, which can be pretty complicated. My team and I, we consult on just innumerable OZ deals, and we prepare many financial statement audits, tax returns, and OZ compliance engagements for our OZ clients.
Great. Thank you for that. Thank you, Jason. Thank you, Brad. Thank you, John. So I'd like to start the conversation by bringing the listeners up to date on where we are with respect to various pieces of legislation that would extend, expand, or otherwise enhance a number of the tax incentives that we discussed during the Senate Finance Committee hearing. As I mentioned in the introduction, many elements of the 2017 tax cuts are set to expire in 2025. I will note the lowering of the corporate tax rate is not one of those tax cuts. The lowering of the corporate tax rate from 35 down to 21% was made indefinite, but there were a large number of personal individual tax cuts as well as some business tax cuts that are set to expire. The fact that these are expiring at the end of 2025 makes it very likely that there'll be a substantial tax bill next year or possibly early 2026, with the bill being made retroactive. And the length of such tax cuts, to the extent there is a tax bill next year, if either the Democrats or the Republicans were to run the table, then we'd expect it to be a partisan bill that likely would be accomplished through budget reconciliation, which means about 8 years from now, we could be doing a similar podcast about provisions set to expire. And I'll share more on that in maybe a future podcast. And to the extent we end up with a bipartisan election results where the Democrats win either the House and or the Senate and or the presidency by all three, and the Republicans pick up wherever the Democrats don't, or vice versa, then we're likely to have a bill that doesn't go a full 10 plus years. I'm expecting that we'd see something that is less likely to be enduring, more likely to be short term as well, perhaps a shorter term. I could be wrong. It could be that we'd end up with a bill that is indefinite, or at least changes to the tax that they're all indefinite. Those come at a much higher tax cost. And I'm not sure if that's really feasible. But with that as background, I thought I'd start with you, John, and you can tell us where we are with some of the key historic tax credit provisions in the bill that's been introduced in the House and the Senate dealing with historic tax credits. And then Brad can discuss new market tax credit legislation. And then we'll close this discussion with Jason discussing opportunity zones legislation, or at least some of the key legislation opportunity zones. Take it away, John.
Great. Thanks, Mike. So for historic tax credits, the HTC GO bill was introduced in March of 2023. And it has some key provisions. The first being the elimination of the basis adjustment. That would make the historic tax credit easier to pair with other community development tax credits like the LIHTC, and provide more equity to transactions that use the HTC. It would also provide a 30% HTC for smaller projects, making those more feasible, and lower the substantial rehab test to 50% of an adjusted basis versus 100%, making some projects with higher acquisition costs more feasible. And the last aspect that was covered in HTC GO was eliminating some of the disqualified lease rules, making it easier for nonprofits to be involved in these transactions, or when they are involved, reducing the complexity of those transactions. There's also been discussion about potentially increasing the credit percentage or making it a 1-year credit in the future, though those are not part of the active bill that that has been proposed. So those are the key items, and I think that would have a great impact on the historic tax credits and the ability to get some of these projects done here if they were enacted here.
Right. Thank you, John. Brad?
Yeah, so there's actually several pieces of legislation currently introduced that would help the new market tax credit. The first is the New Market Tax Credit Extension Act. Then there's also the Rural Jobs Act and the Tribal Tax and Investment Reform Act. So the main one is the New Market Tax Credit Extension Act. Currently, the New Market Tax Credit is actually set to expire at the end of 2025. So it lines up with the Super Bowl of tax really well. And, it is why our industry is so focused on ensuring that, we're part of that conversation. The last time the new market tax credit was extended was on December 27th of 2020, when it was had a long-term extension of 5 years at $5 billion for each year. That was actually the 9th extension since it was originally enacted. I think it's time. I think 10th time is a charm. It's time to make it permanent or an indefinite part of the tax code. So we appreciate Representatives Claudia Tenney and Terry Sewell for their introduction of the bill in the House, and then Senators Cardin and Daines for their introduction of the bill in the Senate to make that so. In addition to making it an indefinite part of the tax code, it includes other changes within it that would help improve or enhance the credit. And those include an inflation adjustment that will automatically increase the amount of the annual allocation amount based upon a cost of living adjustment. And currently the bill starts at $5 billion. And so then it would increase from there. It also provides relief from alternative minimum tax provisions, allowing the credits to offset the minimum tax. So that would put it on par with other incentives as well. While that bill is a good starting point, I think, as we're looking at 2025, there's further changes that could improve the new market tax credit. One of those, Mike, you've mentioned it a lot, is elimination of the basis adjustment that is currently required. And really eliminating any kind of basis adjustment really would increase the value and generate more subsidy per tax incentive dollar. So that would be and it really would kind of put it on par with other tax incentives, enabling it to really become more competitive within the market for investors. So that's the main tax bill that's out there. There's also the Rural Jobs Act, introduced by Senators Wicker and Warner. This bill would authorize separate new market tax credit allocation authority for 2 years at $500 million a year. And those would be that $500 million would be targeted to cities or towns with no more than 50,000 residents and any urbanized area contiguous to such a city or town. So under that bill, at least 25% of the investments would need to be directed to persistent poverty or high outmigration rural counties. So this is really kind of creating a set aside for additional allocation to really address some of the issues in rural communities. And then finally is the Tribal Tax and Investment Reform Act, introduced by Representatives Moore and Schweiker. It would add an additional $175 million of allocation for tribal areas. And in addition to it kind of creating this new set aside, it would also remove some of the current hurdles many investments in tribal areas experience now due to the unique governing structure within tribal areas and how they're treated as either government entities or tax exempt entities. And it would allow those to essentially be considered a qualified business automatically and not have to deal with some of those hurdles due to the unique nature of how they're organized. And this has really kind of been a hurdle that has prevented some new market tax credits being invested in tribal areas. So it's really it would be an improvement and help really direct more dollars into those areas. And so those are the 3 bills that are currently out there, and hopefully will be part of the conversation as we move into 2025.
Right. Thank you for that, Brad. I will note that and many listeners know there is an effort to try to make the new market tax credit program as part of year-end tax legislation, if there is any. All the years we're talking about here, or to if there isn't a year-end tax bill, there'll be efforts to ride on that bill, and the degree of which regular incentive can be successful It's certainly unknowable right now, but it'll certainly be something that everyone is then focused on, knowing that 2025 is coming, but if trains leaving the station at the end of this year through a tax bill, every tax incentive will be trying to arrive at least some of the provisions they'd like to get enacted. With that said, Jason, I'll turn it over to you to talk about OSTEA. You can explain what OSTEA is to our listeners.
Sure. It stands for quite a mouthful. It's the Opportunity Zones Transparency Extension and Improvement Act of 2023. We obviously go for OSTEA to shorten things up. So this bill was originally introduced in both the House and the Senate in the previous Congress. But so far in this Congress, it's only been introduced in the House. As you noted, this is a bipartisan bill, both the Senate version and the previous Congress, and then House in both the previous and the current Congress have been bipartisan in their co-sponsorship. And see, one of the criticisms of the OZ incentive is that it's been difficult to gauge the success of the incentive due to there being minimal reporting requirements. And so if you reflect back to the original standalone OZ incentive, which was the Investing in Opportunities Act, it contained extensive reporting requirements. And then with those requirements being required to be reported to Congress so that Congress could then monitor the impacts of the OZ incentive. But as you noted, the OZ incentive was passed as part of the Tax Cuts and Jobs Act through budget reconciliation, which meant that all of the non-budgetary provisions of the bill had to be removed under the Byrd Rule. So reporting requirements got cut out. So OSTEA, one of the most important parts of it is that it would reinstate those reporting requirements from that original standalone bill. And then in addition, it would also extend the deferral period from December 31st of 26 to December 31st, 28. The purpose of that 2-year extension is meant to offset the nearly 2-year period it took for final regulations to be put in place. There was a lot of investor hesitancy to jump into the incentive in those initial 2 years until finally at the very, very end of 2019, the regulations were finally enacted. The legislation would also replace certain higher income census tracts as those that are currently designated OZs, would require those to be replaced. It would designate certain brownfield census tracts as OZs. It would allow for a more flexible fund of funds investing model, which would help to encourage some smaller investments, particularly in rural areas, we think. And it would create a state and community dynamism fund. And that's the only active bipartisan legislation that's out there right now, Mike.
Thank you for that. And of the three of you, I think Jason could probably speak the most, including all legislation that made reference to incentive, because there have been a number of one-off opportunity zone bills that have been introduced over the last year and a half. With that said, I did want to turn now to the ability to combine various tax incentives. That was a common theme at the Senate Finance Committee hearing. I did get a number of questions. My first question was from Senate Finance Committee Ranking Member Mike Rato about the ability to combine various incentives. I will say during my testimony, I emphasized limiting the basis adjustment quite a bit. And I focused with both the historic credit and the new market tax credit, how if the basis adjustment was eliminated, it would be more valuable to investors. As a consequence, you get more equity per tax credit. In some ways, a basis adjustment for the credit is almost equivalent to making the credit a taxable credit. And I was suggesting that eliminating the taxable nature is a very cost-effective way to increase the value of the credit, so the existing allocations can go farther. But basis adjustments aren't just about increasing equity value; it also affects the interaction of the credits. But broadly speaking, I wanted each of you to touch base with respect to new market tax credits, historic tax credit opportunity zones, in terms of combining with other incentives, including combining them with the low-income housing tax credit. And I did want to mention, with respect to the low-income housing tax credit, since I talked about the bills for historic tax credits, new market tax credits, and opportunity zones, at least the principal ones, I wanted to note that the Affordable Housing Credit Improvement Act is the critical bill for the longest tax credit and productivity bonds, and that it would provide a number of enhancements to the long-term tax credit, but most notably, from a production financing perspective, it would increase the volume cap of 9% credits. It would lower the finance by test from 50% to 25%. So the existing bond volume, productivity bond volume authority can finance considerably more developments. And thirdly, it would also provide basis boosts for rural, native lands, and other areas that allocating agencies were to determine needed a 30% basis boost. State agencies can do that now. Credit allocating agencies can do that now for 9% volume cap credits, but they cannot do that for productivity bond finance 4% credits. But with that, I'll start with you, John. You're the lucky one that gets to go first. And then once again, I'll go in the same order. John, you can discuss combining store tax credits with other incentives, and Brad can discuss new markets, and Jason can discuss opportunity zones.
Thanks, Mike. So when talking about combining historic with other incentives and especially the low-income housing tax credit, I see two key hurdles. One you touched on, Mike, was the HTC basis reduction. And this is important not only because it reduces the value of the historic tax credit, but when you combine it with the low-income housing tax credit in a direct structure, it also reduces the amount of low-income housing tax credits that would be available to a project. And so from the legislation with HTC Go, if that basis reduction were removed from the historic tax credit, it could make these low-income housing and historic tax credit transactions all the more feasible. The second item that I think is noteworthy is the amount of bond cap that gets utilized. And currently the 50% test is in place, but as you were noting, there could be a reduction down to 25% with the Affordable Housing Credit Improvement Act. And that I think is important because I've seen more and more very large historic tax credit and LIHTC transactions that combine those credits. And there is sometimes consternation about using so much bond cap in these states where it's a scarce commodity, and the ability to only have to use 25% to meet that test could make some of these really transformational LIHTC historic transactions more feasible. And, they just have a big impact on the locations that they're put in place and offer a lot of affordable housing. So I think it would be really impactful in that way.
Great. Thank you, John. So Brad, if you could touch on new markets and marrying it with historics, LIHTC, and opportunity zones.
Yeah. So, and when you think about combining, I think everyone might have a slightly different interpretation of what that means. And typically when I think about it, it's whether or not the tax credits can be used on the same costs or if they need to be used side by side to finance different portions of a project. And I think that for new market tax credits, there are certain incentives that it works better with financing the same costs, and others incentives that it has to be essentially a sidecar next to. So when you look at historic tax credits, this is one that I think that we kind of see the most often combined to provide an incentive or to provide a benefit to finance the same costs. It can be leveraged together and twinned together. So the historic tax credit, there's really not too many hurdles in combining it with the new market tax credits. Similarly, with LIHTC, the low-income housing tax credit, you can use new market tax credits and low-income housing tax credits together in a project. You just can't use it on the same cost. And typically, the way to do that is to create this condo structure that one ownership entity owns the low-income housing tax credit development, and the other entity owns the commercial mixed use or whatever other aspect of it is that the new market tax credits would finance. So really, if you wanted to try to use these together where you didn't have to create that, you would have to remove the prohibition from you that currently exist with new market tax credits on using them on residential rental, which is what low-income housing tax credits are used for. However, I don't really think that was the intent. But if Congress's intent changed, that's what one of the things that would have to change. And then with opportunity zones, we also talk about these as being kind of sidecar incentives, where again, because of the different nature of each of them, one is more of an is an equity investment tool, and another one is more of a financing tool. They really are complementary tools, but they are so different in nature that it's more, you might see them as different sources of financing on a single project rather than being twinned together to finance the same costs and really drive more benefit on those same costs. So, I think that it was also the intent, and in order to remove some of those hurdles, I think you'd really have to kind of drastically change some of the legislation in terms of how each of those is used.
Yeah, thank you for that, Brad. And before Jason speaks, I just wanted to sort of layer in there, using new market tax credits to provide wraparound services, if you will, for loss and tax transactions was a question that came up at the hearing. And I did note, as you noted, that the current way that's dealt with is through condo approaches. And I do wonder to what extent there could be a regulatory answer that didn't necessitate a condo structure. And that is something that, we'll be submitting comments to the committee on to address, some regulatory approaches that, if there was some safe harbor design that didn't involve having to go through the challenge and added costs of using a condo approach, which, for the most part is used now because that's the area where tax attorneys can get the most comfortable. And then with respect to new markets, I just wanted to note, as you pointed out, the notion of using new markets on the same equity dollars, getting new markets as are coming in for the historics, is not uncommon. However, market tax credits generally comes in as debt and not as equity. And the reason why it generally comes in as debt and not equity is because there's this rebuttable presumption of dealing with recapture of the new market tax credit. And investors generally want to take advantage of this rebuttable presumption. And thanks to your leadership on the new market tax working group, we've submitted comments over the years trying to get the Treasury to change the definition of control for purposes of this rebuttable presumption test. And we've been unsuccessful, unfortunately, but maybe if we could get that addressed, it would make it easier for new market tax credits to be combined with some of the other incentives, most notably opportunity zones. And with that as a transition, I'll hand it over to you, Jason.
Oh, thanks. And, following on what Brad said, the opportunity zones and new market tax credits are definitely complementary tools. They're not duplicative at all. I don't really see a lot of deals that utilize both opportunity zones and new market tax credits, even through a sidecar structure. I think that's, as you noted, the two incentives, they're targeting different sources of capital. They're structured very differently. New market tax credits investors are typically institutional or large corporations, while the OZ incentive is attracting capital from individual investors quite often. The types of projects that are being developed are different. Opportunity zone incentive, as we've seen and as talked about in our recent blog post about our most recent qual survey, we've seen the opportunity zone incentive develop really large number of homes, over 180,000 just as a part of our survey, which we know is a small percentage of the overall investment. Whereas, and many of those are residential rental only projects, where that's forbidden in new market tax credits. So the most you can have is a mixed use type development there. So I think because of that, it's really important, and I know this was noted in your testimony as well, Mike, but it's really important that both incentives be extended or preferably made permanent, just because they both address different sources of capital and different types of investment. That if either were to go away would leave a huge hole in the amount of capital that's available for community development in these low-income communities. Something else to consider when you're trying to pair up these deals. Opportunity zone, the definition of opportunity zone as a low-income community comes from the new market tax credit definition, but only 25% of the census tracts that are available for new markets are actually designated as opportunity zones, a maximum of 25%. So 3/4 of all projects new markets projects aren't going to be in opportunity zones to begin with. So again, just really want to stress how complementary these two are in providing capital to low-income communities that otherwise wouldn't be available if either were to go away.
Thank you for that, Jason. I also want to just remind listeners that back in the day when opportunity zones first were enacted, we were fairly optimistic that the loss of tax credit and opportunity zones could work together a lot better than they turned out to work, given the Treasury regulations and the final rule on the inclusion of in 2026 and the like. I won't go into all the details, but Jason, through his efforts with the opportunity zones working group, has submitted comments to Treasury, making certain suggestions to the regulations that would, if adopted, that the amendments that being suggested were adopted would allow the opportunity zones to work better with the tax credit and help spur more residential rental affordable units getting financed. So let's keep going here. As I noted at the beginning, there's a lot of sections we want to cover. I'd like to direct a particular question to each of you, a question that senators brought up to me not that long ago. And I'll start with you, Jason. Senator Mike Crapo asked about what improvements are needed to ensure that capital continues to flow to opportunity zones. And I did not get a chance to answer that question. My friend Jay Hawkins with the Opportunity Funds Association got that question started initially, and I didn't have wasn't enough time left for me to respond. But what are your thoughts?
First and foremost, passage of us to you. That's the Transparency Extension Improvement Act. To keep the flow of capital flowing, we really need the 2-year extension. That's a part of USDA to prevent any type of pause or investor uncertainty of whether the incentive is going to continue. So we really need that. We really need reporting requirements in place as soon as possible. You noted that if there is a sweep from either party, then any type of tax legislation would likely go through the budget reconciliation process, which would mean any reporting requirements would be taken out again. So we'd like to see that get put in place before we address the long-term nature of the OZ incentive. But really next up would be an Opportunity Zones 2.0, where we sort of take lessons learned from this first round and we establish at least a 10-year extension or a new renewal of the incentive that would allow for redesignation of opportunity zones. We suspect, we're still waiting for census data to catch up, but we suspect that conditions have improved in a lot of the low-income communities that were originally designated, in no small part due to opportunity zone investment. So it will be time to allow governors to redesignate, to allow investment to shift to other communities the need for investment. As part of now we're getting into wish list stuff, right? But as part of what we would like to see, there are a few aspects of the original OZ incentive that have modified, we think could really drive a lot of additional investment into these low-income communities. One of those is dealing with interim gains, which I don't want to get too tax wonky here. The way that the OZ incentive works now, if you recognize capital gains within the first 10 years of holding an investment, then that capital gain is fully taxable. Whereas if an investment's held for at least 10 years before it's sold, any gain from that can be tax-free. So this discourages a lot of potential investors from even participating in the incentive. Think of venture capital, private equity, that investors that may have a shorter period investment strategy. And so they just avoid the OZ incentive because they don't want to hold investments for 10 years. So we think that a better result would be to allow investors to treat gains from a sale in this first 10-year window, kind of similarly to how Section 1031 gains are done. Whereas as long as the fund reinvests 100% of the proceeds from the sale, the investors will not have to recognize the gain. So that's reinvestments back into new OZ property. So if you think about this would allow potentially the same original OZ investment to finance 2, 3, maybe 4 different investments during that same 10-year window, rather than being just into a single investment. So that allows that same capital to be used over and over again. The second piece that is prevented, and I didn't talk about historic tax credits earlier, and how they combine with opportunity zones, but there's a rule within opportunity zones that says that if a property, a tangible asset is unqualified or non-qualified, any improvements made to that are themselves qualified. And so this has kept numerous opportunity zones deals or opportunity zone investment into historic tax credit deals where quite often there is some type of ownership issue with the property that would make it eligible for opportunity zone investment. Huge problem. And it can be fixed really easily. As part of the comments that Mike mentioned earlier that we've submitted to Treasury, we think it could be done in a regulatory manner. But if not, we think at least the next opportunity zones 2.0 can include that. And then the last third piece I wanted to mention is allowing non-capital gain investors to participate in OZ investments. Right now, you have to have a capital gain before you can invest in an opportunity zone and get the benefits from it. And so our thoughts are that sort of set it up similar to a Roth IRA, that it would allow investors, and maybe up to a certain income threshold, we can discuss that, but allow them to invest after tax dollars into a qualified opportunity fund deal. Now there'd be no basis step up that'd be eligible like we get with opportunity zone investment that's financed with capital gains, and that's because the investments, the dollars have already been taxed. So they would still be able to participate in a tax-free exit after a 10-year hold, would allow them to participate in the incentive. Really, it would have pretty minimal upfront costs because, like I said, it's already dollars that have been taxed. So there'd be minimal cost to the government to allow these non-capital gains taxpayers to participate.
Right. Thank you for that, Jason. And as I said earlier, Foresight was able to answer the question that Ranking Member Crapo asked about directly about how to improve capital flows. But I did in my introductory comments discuss the desire to get the transparency through, get that reporting through, talk about getting a 2-year extension of current zones, as well as go through a redesignation process that would include enhancing the incentive in various ways. And then I was also asked by another senator, what's the one change I would want? The one change I would want realistically would be to make have another designation round. That being said, though, my response would focus more on the transparency. Without transparency getting reporting, I think the ability to get another designation round is dramatically hindered. So I definitely emphasize the importance of getting transparency, getting data back. So in designing another destination round, we can use the data that's more current than getting the data we get on a delayed basis from Treasury based upon tax returns, which are only collecting data necessary to assess compliance, not what's necessary to address the policy goals of the incentives. So let's turn to you, Brad, now and discuss new market tax credits. Senator Ben Cardin did ask me about how uncertainty affects new market tax credits and adds unnecessary costs to economic development. If you could elaborate on this, Brad, and probably give a better answer than I gave.
Yes. Well, one thing that's not uncertain is that Senator Cardin has been a true champion of the new market tax credit. And so as you did. I think a lot of credit goes to all of his efforts to ensure that we are where we are now. I know that he would have liked to have seen it made permanent. Maybe it still will be before he leaves, but uncertainty definitely has a tremendous impact in the new market tax credit space. And the way I think about it, there's kind of two areas of uncertainty. The first one is related to whether the tax credit will expire, will it be extended, will it be made permanent in the future? As we talked about before, it's currently set to expire in 2025, and there's lots of efforts to have it made permanent or extended. But having that uncertainty prevents different organizations from planning in the future how they're going to ultimately take advantage of the new market tax credit incentive. You look at investors and they have to plan forward of what their tax credit appetite may be. They have lots of different incentives that they can invest in. And so if there's uncertainty about the future of new market tax credits, they may reduce their essentially their allocation of their tax equity appetite to other tax credits. And so I think that has an impact on not only pricing, but also the efficiency related to how the tax credits are invested. It also, the uncertainty of the program, I think, prevents some sort of investment into the human resources needed to run the organizations, whether it's an investor, it's a CDE, or it's a qualified business. It's a lot easier to make decisions now to make investments for the long term if you know the program is going to be there, if it's an indefinite part of the code. We can't ever promise it will forever be there, but if it's an indefinite part of the code, you can make those investment decisions a little bit easier. Right now, CDEs and investors, have complained throughout the life of the incentive that making, not knowing, as I mentioned, it's been extended 9 times. And so each time that's come up, they've had to determine, what capital they're going to expend internally to better be prepared for future allocation. That just adds unnecessary cost to administering the program. And so I think that uncertainty has added those costs. And obviously, as a qualified business, I think that there's the uncertainty of how can I plan for a project that I'm working on that may not be ready for 2 years from now? Can I plan on new market tax credits financing to be a part of it right now? Maybe you'd go ahead and roll the dice and say, I'm going to plan for it just because it's been extended 9 times. Surely it'll be extended again. But that's not always the luxury that and the risk that all qualified businesses want to take. The other uncertainty that I think exists in the program too is how it's administered. Oftentimes we talk about needing more certainty in the allocation process in terms of when the next application round will open, what awards will be made. Currently, it's we're given seasons of the year to help plan, and I don't know many businesses that plan on things happening some season in the future. I think most of the time, more certainty about what those dates may be, and also consistency in what those dates are, would really help make the tax credit more effective and allow the different stakeholders, the CDEs, the investors, the qualified businesses, the professionals, to prepare for each of those rounds. So I think by removing that uncertainty, I think you'll see a more efficient use of the tax incentive in its deployment and its investment.
Very well said. And I totally agree. And those are some of the points I tried to make during the hearing. You can look at the investors and CDEs, and it's pretty easy to see how investors and the community development entities themselves plan around permanency and recurring schedules. But if rubber really hits the road with those businesses that are seeking that financing and working on a multi-year basis for financing, I always look at the loans and tax credits as an example. I mean, that most allocated agencies have annual time periods wherein they'll take applications and the like. It's very predictable stuff on an annual basis. It's not about seasons. It's very much kind of set in stone, and then they're dealing with next year's guidance, the year before and all the rest. So it's very predictable. So lots of real estate developers can plan ahead to be applying, to the state next year, the year after, and the rest, which isn't so easy with respect to that, with respect to new market tax credits. So definitely permanency would be very favorable. And I will just note also, staying along the lines of the lumps and tax credit as a parallel, when it was made permanent in 1993, wasn't too long after that you saw a notable increase in pricing. And it just shows the value of permanency or indefinite C. Because as you pointed out, it's only permanent until it's not.
Right.
Being an indefinite part of the tax code is huge. Let's turn to the historic tax credit now. I think one of the messages with the historic tax credit is it was saved by Senator Bill Cassidy back in 2017 due to his efforts and a number of others. And as part of that, though, the credit was moved from a 1-year credit to 5-year credit, and that had an adverse impact on equity pricing. And I tried to make the point during the hearing how the equity pricing from the historic tax credit had declined from over $1 to the low 80s to high 70 cent range. And in addition to going from a 1-year credit to 5-year credit, having adverse effect on pricing, Senator Bill Cassidy, asked some follow-up questions how Treasury regulations have affected the ability of the historic tax credit to generate the equity needed to finance historic properties. So, John, if you could discuss a couple of regulatory issues that have adversely affected equity pricing, and anything else that you wanted to share on that topic, please do.
All right. Thanks, Mike. And I'll commend you on your testimony. You did a nice job describing difficult technical topics like 50D income. So I'll try to do the same here. So the historic tax credit has been around for over 40 years now and has a track record of just great success. And I think it's, something that, we can all basically agree on, that it's great to, rehabilitate these properties and preserve, our great history with these buildings. But we've seen a tough 10 years basically for the historic tax credit, where we've seen the pricing drop 20 to 25%, like you noted, Mike. It started with a court case, Historic Boardwalk Hall, which froze the historic tax credit equity market a little over 10 years ago. And that court case led to Revenue Procedure 2014-12, which really lays out how transactions are structured now to this day. But it is a conservative safe harbor that it lays out, and did have a negative impact on pricing overall from what we saw prehistoric Boardwalk Hall. And it requires investors to be profit motivated from that tax opinion perspective. So that does have some negative impacts to how these deals are structured and the pricing for them. Another thing that we touched on was the 50D regulations. So prior to the 50D regulations being released, the 50D income was treated as an increase to a partner's basis. And when the 50D regulations were released, they said that no longer increased the partner's basis, even though it was previously treated that way on prior transactions. And so this had a very negative impact to the pricing as well. And then, as was noted, going from the 5-year credit to the 1-year credit, while we're all very, very appreciative of all the work Cassidy did to save the historic credit, going from a 1-year credit, to a 5-year credit, did have a negative impact to the pricing. And we've seen that go from over $1 to now in the low 80s or high 70s. And then to further add to that is the Inflation Reduction Act, and how it's generated so much more in renewable tax credits, and the structures where you can have you can sell those credits directly and have direct payment has made those credits even more advantageous, and has had an adverse effect to the amount of investors and the amount of investment dollars in historic tax credits. And so I think everybody can agree that it's time that we reinvest in the historic tax credit, and the HTC Go would be a great first step to increase that value back up and create some more flexibility by removing the basis reduction, and then lowering the substantial rehab test, and also having tax exempt entities participate more freely, and then even those other considerations of potentially increasing the credit, I think would be very welcome, and I think very well due.
Yeah, thank you for that. And I appreciate you pointing out the historic tax credit competing with renewable energy and tax credits. We at Novogradac support the Inflation Reduction Act and its expansion and long-term extension of a number of renewable energy provisions. However, it did have a competitive adverse effect on the historic tax credit. Renewable energy investment tax credit is claimed over 1 year, not 5, like the historic tax credit used to be claimed over 1 year. The base rate adjustment is 50%. And as you point out, it's also transferable. So those and other factors make the ITC for many investors more attractive than the historic tax credit. And as a consequence, the historic tax credit, it transacts at a lower credit equity dollar. And that, once again, it's all about creating parity with other incentives, with newly enacted incentives. And just to sort of maybe summarize for the listeners and viewers for our audience, basically, Boardwalk Call led to a sort of safe harbor that became the standard, and that had an adverse effect. And I will just note with this Boardwalk Call, initially the tax court ruled in favor of the taxpayer, and everyone was rejoicing until they weren't, and it was overturned. So it's just a lesson that if you win at the tax court level, don't assume you're going to win if the IRS feel that you'll win at the appellate level. And it's also, a sign that, even if it hadn't been appealed, and it would have been a note to others to say, well, even if we were successful at the tax court level, maybe we need to design the transaction to be less towards the edge. And the historic Boardwalk Call was definitely one of those situations where, it was a bad fact pattern that led to a bad ruling, which then led to the need for a ref talk that led to a conservative and safe harbor that became the standard. But it's basically a historic Boardwalk Call creating a conservative standard. And the basis of the standard is more cash flow having to go to investors. As a consequence, the value of the credit piece is less. And then there's the 50D income, which really dramatically impacted the fact that it is, or reflected the fact that it is a taxable credit. And as we know, the divider credit was the third, the fourth, it's all the new credits. So with all of that said, I did want to get each of you an opportunity to share something at the hearing that caught your attention, or something you found particularly striking or surprising or even affirming. And I'll start with you, Jason.
Sure. I felt that the discussion around opportunity zones was somewhat limited, but then that might be perhaps due to Tim Scott being unable to attend the hearing. I think if he had been there probably would have been at least a few more questions from him regarding opportunity zones. But I thought it was really great how strongly Mike Crapo expressed support for the OZ incentive. I think it's really important as we head into an election where control of the Senate could potentially flip. So it's very good to see Ranking Member Crapo so fully support the OZ incentive. And then I thought it was really neat that we finally saw some additional total investment data from JCT on the OZ investment, which at the end of 2022 was up to 84.7 billion in total, which is sort of the first verified total we've seen since 2020. So I was glad to see that as a part of JCT's report that accompanied the hearing.
Right. Thank you, Jason. Brad?
Yeah, I think for me, it was nice to see the bipartisan support. Not only was it supported by the chairman and the ranking member, but it just seemed that there was this understanding of new market tax credits that was refreshing to see amongst most of the members, and just their ability to talk about it and even identify projects within their in their areas. And so I think that really just was a testament to all of the efforts that have been made over the years in terms of advocacy and educating members of Congress, and that now it's easier for them to discuss new market tax credits. And I think that to me, that was the most refreshing part, but also a reminder that just because this group understands it and appreciates it doesn't mean the next group will. And with elections, there's guaranteed to be some kind of change. And so I think that, it just emphasized that advocacy works, education works, and that once you show them how these incentives are doing good things in these low-income communities, that it's easier for them to support and to get behind.
Right. Thank you for that, Brad. And yeah, there'll definitely be, a few seats available on the Democratic side of the Senate finance committee based on retirements. So we do expect to see, some change on the Senate side, and on the House side, there could be dramatic change if the Democrats were to take control of the House representatives. John, talk to me about historic tax credits and something that was affirming or surprising in a good way.
Sure. So I'll first just kind of echo what Brad said. It was just really great to see, bipartisan support for all the credits, and just to hear everybody talk about the historic credit, and Cassidy's pointed questions on, what's caused a reduced value was very interesting to hear. But I wanted to note one of the statistics you brought up, and that the historic credits driven over $235 billion in private investment and created 3.2 million jobs. And just, such an impressive statistic for the credit. But also wanted to note a couple that were in your written testimony, Mike, that I think are equally impressive. And that we see that 40% of historic tax credit properties placed in service between 2013 and 22 are in predominantly minority census tracts, which is very impressive to see the historic tax credit having that sort of impact on those communities. And that and another point was that more than half of historic properties are in low and moderate income census tracts, and 75% are in HTC 75% of HTC properties are in economically distressed communities, which I think is just kind of surprising to see that those dollars are going to that, and there's no real incentive that causing that, but great to see that. And then the last one I wanted to point out was that through 2022, $50.3 million of federal tax revenue has been created from $44.3 billion in tax credits. Hopefully I said that right. $50.3 billion in tax credit revenue from $44.3 billion in tax credits. And that's the one that, drives it home the most to me, is that this is a program that pays for itself and rehabilitates our properties. And I think that's the reason for us to continue to invest in it.
Right. Thank you for that. I'll give each of you now an opportunity to share some other takeaway that you think the audience should know about. Maybe I'll go Brad, and then Jason, and John again.
Yeah, I think again, I don't know that there's too many other takeaways. I think that for new market tax credits, there really is going, if it doesn't happen by the end of this year, as you mentioned, there is going to be this intense focus on the end of 2025. And I think that as an industry, we need to stay focused on ensuring that it does get extended or made permanent. And as I mentioned just previously, the fact that not only does the Senate Finance Committee, but the House Ways and Means Committee knows so much about the new market tax credit and effectiveness. I think that we're in a good position, but nothing's assured. There's a lot on the plate, and my fear is that it's not done soon enough, because I think that if the tax legislation isn't passed until 2026, it will definitely have an impact on new market tax credits in terms of how CDEs behave and how investors behave and how qualified businesses behave. And I think that, as I mentioned before, just the certainty before then really is crucial at this point, and really just critical for the success of the program in the future as well.
Thank you for that. Jason?
Sure. Sort of to paraphrase Mark Twain, the reports of OZ's death are greatly exaggerated. I'd hear people talking as if the OZ incentive was already over. They're like, oh, that's still going on. There's still the better part of 3 years time to invest in OZ projects. And with so much of the value of an OZ investment being in the 10-year hold and not in the deferral, there's not really a disincentive to stop investing now. It's even more important to, I think, get investments made in the opportunity zone so that 10 years down the line, investors can experience a tax-free exit. We know there's going to be a strong push in next year, maybe early 2026, to extend a lot of the expiring provisions of the Tax Code and Jobs Act. And something else to keep in mind is opportunity zones is bipartisan, and it always has been. The initial incentive was purely bipartisan. I know that one party has sort of taken a lot of the credit for it because it was passed in 2017, but it always has been and remains a bipartisan. And so we think there will be a lot of opportunity for inclusion of this in any tax legislation that goes forward, because there's going to be this across the aisle agreement that the incentive does work.
No, I appreciate your emphasis on the bipartisan nature. And it just reminds me that Cory Booker, who's the lead Democrat supporter of opportunity zones, there's a chance he could end up on the Senate Finance Committee. If both he and Senator Scott on the committee, and I know he's pretty powerful. And then Jason, you mentioned roughly 3 years. Maybe explain to listeners how gains for 2026 can be invested, what the timeline would be for when gains from 2026 would be invested in opportunity zones.
Sure. So this covers, the incentive covers investments of gains that are realized up to December 31st of 2026. So that's for a direct gain. So if you're an investor that sells some stock before or on December 31st, 2026, you can still invest that into an opportunity fund and recognize the 10-year hold down the line. You have 180 days to do that. But even further into 2027 now, so that puts you almost to July, so deep into June, investor with a direct gain. If the investor has a gain through a pass-through entity, such as a partnership, the starting point of that 180-day investment window is the due date of the tax return for that entity, which would be March 15th, which is going to then push the potential last date for an investment in a fund out till somewhere along the lines of September 10th or so of 2027. So there's still, it's only August 13th of 2024 now, so that's more than 3 years, which investors can still get investments into opportunity funds and take advantage of that long-term incentive.
Great. Thank you for providing that detail. I actually wanted to highlight the fact that, to your point about, opportunity zones aren't dead yet, and they're not, and investments in funds isn't down December 31st, 2026 either. And you noted that in your 3-year reference, but I just wanted to emphasize that point to our listeners. And John, any last takeaway?
Sure. So, Mike, this is another one that was in your written testimony and didn't make it into the Senate hearing, but I wanted to note on the proposed Revitalizing Downtowns and Main Street Act. This is legislation that's out there now that legislation that's out there now related to the commercial real estate and the shift to hybrid work that we're seeing now and some of the commercial properties being underutilized. And the legislation will provide a federal credit of 20% for qualified conversion expenditures for buildings that are at least 20 commercial buildings that are at least 20 years converting into housing. And there's a requirement that at least 20% of the residential units be reserved for individuals with incomes of 80% or less. And the reason I bring this up is the proposed bill out there would have a 50% basis reduction to the commercial conversion credit if it's paired with the historic tax credit. And, what was noted in your written testimony and what I would echo is that, we would recommend that if this legislation moves forward, that there be no reduction on the conversion credit if used with the historic tax credit. Because, we'd be concerned that, first of all, the cost for doing historic tax credits, there's definitely a cost associated with it for doing this type of rehabilitation and for, going through the process of having it be a historic tax credit building. And we'd be concerned that developers may forego preserving the historic character of these properties and taking the 1-year conversion credit rather than taking, going through all these steps and having a 5-year 20% credit and then a 1-year 10% conversion credit. The reason I note this is I think this legislation is great, and I think it has an opportunity to really help the historic tax credit program and help to revitalize it. What we talked about earlier,
Yes.
we've seen that decrease in the value. And I think this would be a perfect opportunity to kind of revitalize that market and to leverage the historic tax credit to really rehabilitate these commercial properties that are underutilized right now, and kind of reinvigorate, the investor market for these. I think that combining both of those could create some great transactions for the cities that have these commercial buildings that are underutilized. So really wanted to emphasize that point you made in your written testimony, which I think was excellent.
Thank you for that. I wish Senator Stavin had been able to make the hearing because I'm sure she would have brought up that legislation that she introduced in the Senate with Representative Kerry and Ways and Means introducing the companion bill in the House.
Mike, if I could add just
Please.
one thing briefly. One thing that I think all of us probably want to is anything that would increase the investor market for these tax incentives. I think in a lot of the legislation that we discussed at the beginning, there are changes in there that would help bring in additional investors, which just would make it for a more competitive environment. I think that competitive environment obviously will have a positive impact on pricing. And it's not just within the legislation itself for each of the incentives, but it's things outside of the legislation. You have the base erosion tax provisions, the global minimum tax, the 75% limit on general business credits, accounting treatment, regulatory rules. There's all these things that with some changes could ultimately bring in more tax credit investors, which I think would ultimately benefit all of these different community development incentives.
Right. Thank you for that. I would direct our audience to my written testimony. And thanks to all three of you for helping with the written testimony, along with Peter Lohner, head of government relations. There is a section on the investor market that does address those certain points about trying to do something that increases the desirability of investors, all the credits. It's not just about parity. It's also about other changes or enhancements. So thank you to each of you for being guests on this episode. Please stay around for our off mic section. To our audience, I encourage you to reach out to the guest today if you have questions about the tax incentive we discussed today. And if you're listening to the podcast and you're interested in getting more involved in the efforts to expand, enhance, and extend these tax incentives, I'd encourage you to join us in Kansas City on October 10th and 11th. If you're interested in the historic tax credit, if you're interested in opportunity zones, we'll be at the Fairmont in Washington, D.C. on November 6th. And if you're interested in opportunity zones, I also encourage you to email Jason and join the Novogradac Opportunity Zones Working Group. And then we also have between our Historic Tax Credit Conference, October 10th and 11th in Kansas City, and our Opportunity Zones Summit, November 6th in D.C., we have the Novogradac Fall New Market Tax Credit Conference at the Roosevelt Hotel in New Orleans on October 24th and 25th. And just as I mentioned, if you're interested in opportunity zones, reach out to Jason for the Opportunity Zones Working Group. If you're interested in new market tax credits, reach out to Brad for the new market tax credit working group. And then I'd be remiss that we talked a lot about loans and tax credits as well during the course of this podcast. And the Novogradac 2024 Housing Tax Credit Bonds Conference will be at the Four Seasons, New Orleans, on September 26th and 27th. So about a month and a half away. And we also have a Novogradac Long-Term Housing Tax Credit Working Group. If you're interested in getting more engaged in legislative and regulatory impact, then please reach out to my partner, Dirk Wallace, or just email cpas@novogradac.com. I will include contact information for our guests in this week's show notes. I'll also include a link to the Senate Finance Committee website. If you would like to watch the hearing, it's also on YouTube. I believe it's posted to YouTube now. And then you can also access my testimony through that site as well. And then lastly, before we get to the off-mic section, please do subscribe to the podcast on whatever platform you prefer. And please do also share the podcast with your colleagues so they can learn more about the tax incentives that we discuss every week here on Tax Credit Tuesday. Now, turning to our off-mic section, this is a space that gives us an opportunity to give a shout out to someone working in the various tax incentives that Novogradac participates, and sort of basically highlight a professional or someone else in the community who really deserves recognition for the good that they're creating. So I'll ask each of my guests to give one shout out, and I'll start with John.
Thanks, Mike. So for my shout out, I wanted to shout out the leadership of the Historic Tax Credit Coalition. Patrick Robertson, who's the executive director, and Forrest Milder, who's the chair of the board of directors, and then all the other board of directors, including you, Mike. I wanted to shout out all the efforts they've had in promoting the historic tax credit, HTC Go, and then moving into 2025 with our upcoming Super Bowl of tax.
Right, Jason.
Yeah, I wanted to call out my friend Alex Lackbart with Opportunity Alabama. Alex has been such a cheerleader for the OZ incentive, not only in Alabama, and helping get the investment and get the word out. And so throughout the entire state of Alabama, not just in urban areas. And then, he's really been a huge proponent in DC as well. So I just wanted to give a shout out to Alex. We've certainly featured him in the Journal Tax Credits previously, but I just wanted to add some additional shout out here.
Brad.
Yeah, I actually wanted to shout out Chairman Wyden and ranking member Crabo for having this discussion, to put it on and put it at the forefront of these before we get to the Super Bowl of tax per se. I think really just highlights how important these incentives are, and when it comes to investing in these areas and in these communities that they're focused on. So I think, not enough attention can be brought to these. I think they need all of the attention that they've earned, and anything that will help highlight the good that they're doing I think is helpful. And so I appreciate them giving these incentives that platform.
Great. Thank you for each of your shout outs. And I echo all your shout outs as well. I'd like to also thank you again, John DeJovine, talking about focusing on historic tax credits, and Brad Elphick joining the podcast to discuss new market tax credits, and Jason Watkins joining to discuss the Opportunity Zones incentive. Thank you for being on the episode. It's a pleasure having each of you back on the show. And to our audience, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.